Right.
So if I have to make a very loose comparison, it's like asking what is the right age to get married.
Hi, good evening, good morning, depending upon where you are in the world. So excited and perhaps a little bit nervous to start AAA's first podcast. This is a new format. AAA is the whole idea is to build a community, make the community come together, and there is so much of Ajitness that can be leveraged for us to bond, help each other, support each other, and then so on. So, one such small endeavor is through this podcast. Today, I have with me Samir. Welcome, Samir. Thank you so much for being here.
My pleasure. Thank you for having me.
So, yeah, thank you. It's an honor to have Samir here. Uh, Today, we are talking about if you are a business, how do you raise capital? And more importantly, how do you raise equity capital? What does it involve raising an equity capital? That's a topic. We will try and make it as simple as possible. It's a very complex topic, but we'll try and make it because we've been hearing a whole lot of stuff, right? Okay, somebody become a unicorn, right? Someone suddenly become a millionaire or things like that. And then what do these things really mean? And then we'll try and understand some of those things today. Just a quick introduction of Samir. A lot of us would know a great pedigree. NITK Suratkal. I am Calcutta. So that's a super pedigree that he has. But to me, and then most of us here, I think the biggest pedigree that he has is he actually studied from Sainik School Bijapur. That's the coolest school that he ever went to compared to everything that he's gone to. So for rest of the stuff, I think a lot of us know Samir through his public profile, LinkedIn. He's an author, and then so on. So you can figure out whatever is there online as far as his introduction goes. But today, what I'm keen to know is, Samir, can you tell us something that maybe not available publicly? Don't tell all the secrets, but let's know what is it that we would like to know who Samir is really before we begin.
Sure. Like you said, obviously people know me as part of Vidura Capital as an advisor and investor in companies
Yeah.
listed and unlisted. Beyond that, a couple of things is one, I'm very passionate about following and playing cricket. I prioritize it over many other things in life.
Right.
That is one. And second, of
Huh.
course, you briefly mentioned that I am an author. So many people would also know me as somebody who is crazy enough to think that, English is not going to be the first language of the world forever. There is a language better qualified than English, is what I truly believe, which is Sanskrit. And, I made a small effort to write a book mentioning that Sanskritam, future language of the world, the book is. So
Yeah.
those are a couple of things that probably, many people don't know me. So that's a small intro.
Yeah. Amazing, Samir. No, I did have a chance to read the book. Great argument in terms of, we'll talk about that sometime later.
Sure.
Rather, pick your brains today on being an investment banker.
Sure.
I think that subject is a podcast in itself. I'm sure somebody will do who is better equipped with Sanskrit. So today, almost all businesses, right, they will require capital unless one is very rich because it takes some time. We need to build the product. If it is a manufacturing, buy land, build machinery, and then so on. It takes some time as well as some money to get to selling and then making profit. So until then, we need to raise capital. All businesses require capital. Whatever little I understand, there are two ways of doing it. One is through debt and other one is through equity. Can you help our viewers? What is the difference? What do these things mean?
Sure. See, put very simply, right? Debt, you are borrowing money, you need to repay with the interest. Okay. So that's the liability of the company. If company
Right.
borrows capital, which in the form of debt, then they are required to repay it in a defined timeline. Okay.
Right.
So that is the nature of debt. Okay. When it comes to equity, you are not required. Company is not required to repay it. Equity in its purest form is you take money and you issue shares. The upside is unlimited. There are no guarantees when it comes to equity. Downside is, all the money invested by an equity investor can be lost if the company share price, kind of gets eroded, becomes zero, or
Right.
company goes bankrupt. So from an investor perspective, equity is a higher risk, whereas lender is taking limited risk. he is not enjoying enormous upside if the company becomes very, very successful in a short period of time after borrowing from that particular lender. He gets his money back. That's his this thing, risk appetite. Whereas equity investor, he plays for the upside,
Sure.
and he's the last, the most subordinate, in terms of when let's say company gets dissolved, the debtors get paid first. And equity shareholders, if the company is dissolved, equity investors generally make no money most of the times. They lose everything. So it's a higher risk from an investor perspective, but from a company perspective, it the founders or the owners of the company, they have to part with the ownership in the company. So they part with the ownership, but there is no serious liability. So if I have to speak little technically, by borrowing, your bankruptcy risk goes up. By raising equity, if anything, your bankruptcy risk can go down. Yeah.
Right. So typically, if somebody wants to start a business, doesn't have a lot of capital, the option typically is equity. Yes, you lose your ownership in the company, but that usually comes with some or the other form of collateral, right?
Yes, mostly.
Yeah. So that's the balance. That's a trade-off that the founder has to make, right? And it's not as binary as we think it is. It's a trade-off that one has to make.
Yeah, but mostly in early stages of the company, debt is very risky from a founder perspective.
Is it? Okay.
Yeah, debt is very risky from a company founder perspective because the idea is still taking shape. Ultimately you have to repay the loan from the profits you make, and profits can be quite distant in the future in terms of the journey of the company.
Got it.
And loans come with a very defined timeline. And when you start a company, no matter how well prepared, how deeply you have thought through, still the future is uncertain. So unless one is very sure about the glide path of the company in terms of how much profit it can make, how quickly, debt can be very risky. And if they go out to raise debt from, professional lenders, lending companies, very high chance they won't get it unless they have raised substantial amount of equity and there is lot of proof of concept in their business model. There is already very good traction in their business. It's highly unlikely that one can straight away take debt.
Sure.
Whatever I'm saying, nothing is cast in stone. I am speaking from generally tech-driven startups.
Sure.
But there are also manufacturing companies who can start making profits very early in their journey. And like you said, they do need machinery, land, building, everything. So these are assets which can be pledged and then you can borrow. There are many lenders who finance the machines because they know that they will have a recourse. They will have a recourse in the form of that machine. But now a lot of starting up has got to do with, tech ideas, right? Where there are no hard collateral, etc. So I was speaking from that perspective.
Got it. Sure. Yeah, Samir. Now, so this is a live event, Samir. So we get questions from audience as well, and then I'll try and mix them along with while I'm asking. So I know like Halaswamy and Basu Aniyapne are here, so they had similar questions, right? Essentially, Halaswamy, a bootstrapped manufacturing founder, Basu, an angel investor. They come from two other sides again. So they were kind of wanting to know from you as well as I, when should one look at venture funding? Let's keep that aside for a while.
Yeah.
When should somebody really raise money through venture? When should somebody not raise money through venture? Is there a stage? Is it when you make money, or is it when you get traction, or is it very early? Are there any guidelines around it?
Right.
That's
See, straight answer is there is no one size fits all. To each founder is own in the sense that what is his vision, how big he wants his company, and how fast he wants to get there. It's a function of all these things. If we look at the landscape of startups, right, across the world, there are enough and more examples of companies which have raised very early, right at the idea stage, and yet have become a very big success. And there are enough and more examples where people have deferred their plans to raise capital and yet have become successful. So if I have to make a very loose comparison, it's like asking what is the right age to get married, right? To each his own. To each his own, right? Okay. But let's try to make sense of this, right? Let's put some science into this question, because it's a very good question and a very valid question. Ultimately, there is an opportunity. The founder thinks that there is a very big problem that he is solving. Okay. And he is in a very unique position to solve that problem. Okay. Now, the reality is that he has to grab those opportunities, because there is always going to be competition. No matter how much companies say we are inward looking, we don't look at what competition is doing. The reality of the world is you are competing. You are competing when it comes to business. Okay. So you are competing. So how fast you want to go and grab those opportunities? Okay. Now you have a timeline in mind. Okay, within let's say 3 years, 5 years, I want to get this big. Okay, then how much capital can you as founders contribute? How much capital do you need? If you are profitable from day one, it eases your burden to an extent that you can fund the growth through the profits. But oftentimes, when founder has a very ambitious plan, ambitious growth plan, even profit-making companies, they will be required to raise external capital, because profits are not enough to fund all the growth opportunities at his disposal. So it is all about how quickly he wants to get there in terms of scaling up. He has a unique idea and he's in a very good position to solve that problem. He needs a certain quality of team and certain, team size, etc., for which he has to do the math and arrive at what kind of capital he would need along the way. How much capital does he need in year 1, year 2, year 3, external capital? And accordingly, he has to plan this. If somebody, let's say, if somebody is already running a company which is, quite pedigree, 10 plus years, already making good profits, he's happy growing at a certain rate, let's say 20%, 25% every year. He's not in a tearing hurry to double every year. Okay.
Got it.
Because if you raise venture money or private equity capital, okay, then it necessarily comes with certain growth expectations. They expect you to grow much faster than what a company otherwise would grow with resources at its own disposal. So necessarily there is pressure to grow faster. So the DNA of the founder has to align with these expectations. So if somebody is running business not to grow very fast, there is nothing wrong with that approach. He just enjoys running at his own speed. But the minute you take capital from an institutional investor, you would be obligated to run at a certain speed and run in a certain way.
Oh no, I know that. So there's typical thumb rule: 3x, 3x, 2x, 2x is what I was told if I were to raise money from a venture capital. So essentially, as soon as you raise money, Samir, so I was told that, okay, if you're doing 1 crore, the year 2 should be 3x, which is 3 crores. Year 3 is another 3x. So 3x, 3x, 2x, 2x. So 1 crore to 3 crore, 3 crore to 9, 9 to 18, 18 to 36.
More the merrier.
If I'm not able to do this 3x, 3x, 2x, 2x, then it is hard to raise vendor. That's the pace at which one has to run if you make venture capital, at least early stage, Series A types, right? And we have both the examples, right, Samir? So in the same industry, coming from the same thing, Girish Mathrubootham built Freshworks, raising huge amount of venture capital, right? I think he raised upwards of $100 million before they went public on NASDAQ.
Yes.
Same city, similar business, a little bit earlier, Sridhar Vembu built Zoho with no capital. As in no capital and no external capital raise, right?
Yes. He started making profits early in the journey. And he used that to grow.
Maybe it's taken him longer, but perhaps these are the two sides of the two extremes, and most companies are somewhere in between this.
Yes.
And Right. I mean, therefore, there's no really a thumb rule, but thank you for giving us how should a founder think in terms of like, should I take Sridhar Bamboo's route, or should I take huge capital raise if I'm hungry for 3x kind of a growth, or should I be looking at this? Amazing. Thank you for that.
Yeah.
The other very, really, really simple and fundamental question a lot of people read in the papers, and then I guess my viewers would have this thing where all these terminologies, right? Okay, there's an angel investor, there's a seed investing, there is a venture capital, Series A, Series B, and then so on, and then P investors. And so what do these terms mean?
Yeah, sure. So, when you talk about pre-seed, seed, pre-series A, Series B, these are all stages of the company. When you talk about, say, angel investor, venture capital investor, private equity investor, these are types of investors. Okay, there is a stage of the company, and then there is a type of investor. For example, let's talk about angel investors. These are all individual investors who can invest in pre-seed stage also. They can come in at seed also, even in pre-series A also. They can invest. So it's about this is about angel investors. Now VCs, right? VCs are people who invest in, mostly when it comes to Indian market, they mostly invest in tech-driven businesses. Mostly, these are people who invest in tech-driven startups. Whereas private equity investors, these are people who invest in companies who are already making profits. They have a track record of growth in revenue as well as profits. But like I said, there are always exceptions to the rule. There are also examples where private equity funds have invested in non-profit making companies. But that is more like an exception to the rule. And then there are buyout funds. Again, private equity, under the broader private equity umbrella, there are buyout funds and growth capital funds. Buyout funds buy companies out. They transform those companies. They take it to a different level altogether and then sell them. They can list and then sell them. They can dilute their stake after listing, or without listing, they can exit through M&A deals. So there is stage and there is type of investor.
Got it. Okay. Just to again kind of summarize what you're saying, Samir. Essentially, seed is very early stage. The people who fund, basically this fundraise is done at an idea stage to build a prototype or to show some.
Earlier than seed.
Earlier than that. Okay, all of these typically, right? You don't have a product ready, maybe some prototype or whatever that you're trying. Basically, people bet money on your idea and you as a person, etc.
Yes.
Typically, the world calls it as friends, family, and fools round. So, and then comes the venture, right? Which is Series A, B, C. Typically, you go to venture capitalist from Series A to D or whatever it is. Typically, when you start making money but not profitable yet, you've proven the product, there is some concept, there are some customers, but you're not making money yet, but you need to pump in a lot of money to grow the business. That's when these guys come in. And once you start making money, the big boys, P's will come, Blackstones of the world, and then they will come in once you started making money, give exit to the VCs.
Or you can list as well.
Yes, then they take it to public. Yes.
Just one small point, Milind, if I have to be extremely technical, right? So venture capital, even an angel investor's investment can also be called venture capital because he's investing in a venture. It's investing in a startup. But typically, a VC investor refers to an institutional investor.
Yes. That's
institutional investor who comes in a little later stage. But now, with so much startup action happening, even those who invest in seed, pre-seed stage also, there are many institutional investors who come in early. And to answer very simply, to make it very simple, why people are trying to invest earlier, although the risks are very early, because you said fools, because they are not supposed to be investing so early because there are so many risks and the outlook is not clear for which way the venture is headed. The reason why people are still willing to invest very early is because they can multiply their capital at an extremely, faster rate. The earlier they come, the multiplier on the investment is higher, provided the company becomes successful. Let us say Zomato.
Yeah.
Let's say Zomato, right? When it listed, you have invested. You may have made 3 times, 4 times, 5 times, depending on when you came in, when you exited, etc. During listing or post listing when you invested. Whereas imagine if at the time he was starting up and you were one of his friends, he reached out and you said, okay, let me invest.
Yeah.
If you made 5x after listing, then if you had invested then, you may have made 5,000 times also or 500 times. But this is an extreme example,
Extreme.
right?
Rajiv Bikhchandani invested in Zomato, the founder of Make My Trip and Naukri.
Right.
He was one of the angel guys with Zomato, and then when they listed, I think 11,000 times or something like that, some ridiculously high number. We all know Ram Sriram investing $100,000 in Google in 1999, a professor at Stanford. I don't know how many thousand times it was that 100,000 to become few billions.
Yes.
But of course,
the earlier they invest, the multiplier is higher. But I should also tell your viewers that it looks very amazing when you take these examples, but they are very small, like needle in a haystack.
Yeah.
Most of these are like outliers who have performed extremely well.
Correct.
But most of the angel investments, they become zero.
Yes.
You are also aware. So those which succeed, you should have enough number of successful companies in your portfolio. It's a portfolio approach. You can't just make one-off angel investment and if you are lucky, yes, you invested in only one and it became 100 times, 200 times. That's a different ball game. But if one has to approach this systematically, one is required to have a portfolio. Because no matter how good the founders are, how important a problem they are solving, how dynamic they are, there can always be uncertainties. There are always uncertainties. That is why there are both type 1 and type 2 errors in investing. You may invest in something, which does well, but you may also miss out on opportunities.
Got it.
And you may invest in something which may not do well. So there are both possibilities, both type of errors possible.
Sure. So I think Vijay Singh Thakur, another friend of mine, he's asking question from the audience. I'm bringing that question now, Samir, because this segues into whatever we were discussing in terms of angel and then investing. With Shark Tank, right? There's a lot of romanticism around startup investment, right? And perhaps with a little bit of disposable income, people have 5 lakhs, 10 lakhs, 20 lakhs now to kind of take risks with. Yes. So a lot of people are becoming angel investors and I get worried about it a bit sometimes, right? So I rely on my good friend, if I may say so publicly, like Nara is my North Star. If he says, then I do. So what are some of the cautions that you put when you want to really be an angel investor? Who should and who shouldn't and when not?
Got it. So first and foremost, the first wave of startups, right, when they did very well in India, I'm talking about in Indian ecosystem, not so much the Western ecosystem. At that time, the supply of capital, domestic capital, which is from Indians, etc., was very low. Invariably, they were all reliant on foreign capital. Okay. So that was not good, right? From country's perspective, it created wealth for mostly foreign money, which is good for them. But we missed out on opportunity right under our nose. Okay. So after that, there has been lot of awareness created, and people are consciously taking those risks. It is overall a good thing for the startup ecosystem at a very high level. Okay. But yes, like you rightly said, there are risks. Angel investing comes with lot of risks. So one has to have some rules and framework in place, right?
Yeah.
So first and foremost is, one should not just make it a part of their equity portfolio, thinking that I am not very well placed to analyze listed companies. So here I at least know the founder, etc. That alone should not be the approach, because equity, even though you may not be in a position to analyze individual companies, you may not have competence, you always have an option to buy index. Nifty, for example, it's a basket of 50
No
large
brainer.
companies, and
Yeah.
it has delivered very good returns if you do
Yes.
historical analysis, because large
Yeah.
companies will do well. They will not like disappear overnight and all that. So the
Yeah.
reward may not be as high compared to a successful startup if you had invested
Hmm.
early, but it's a safer equity investment. Okay.
Yeah.
But still, angel investments, I make angel investments and I understand why people do.
Hmm.
One should do it with only certain portion of your capital, which
Hmm.
even if you were to lose completely,
Yeah.
you should be okay with it. Okay.
Yes. Yes.
Okay. For example, my approach to making angel investment is
Hmm.
whatever profits I
Hmm.
make from my listed investments. Okay. Okay. And let's say profits from the business,
Hmm.
a small part of that I invest in angel, knowing
Sure.
very well that all of this could become zero. Okay.
True.
So still I should not lose my sleep. Okay. Because by making angel investments, you learn a lot as well. You know where you are going right, where you are going wrong. Your overall ability to analyze companies
Hmm.
gets enhanced. Okay.
Sure.
And
Sure.
let's say that is helpful in your day-to-day business, then why not? Okay.
Got it.
So
Got it.
so that is one approach one can take. Secondly, I would say one has to have valuation discipline, because
Hmm.
when there is a lot of exuberance about startups, the
Hmm.
valuation expectations reach much higher limits than what one is comfortable. So if you
Hmm.
look at this whole early stage investing, when the exuberance is high, at that
Hmm.
time there is supply of capital, because people have the fear of missing out, and they
Yeah.
end up investing at higher and higher valuation.
Hmm.
Then you are not really setting yourself up for great returns. Some
True.
people say it doesn't matter what valuation you invest in early stage, because
Hmm.
either the company will succeed or the company will fail. If company
Yeah.
fails, it doesn't matter what valuation you invested. If
Sure.
company succeeds, you will anyway make good returns. But how
Yeah.
good? For example, if let's say I'll just throw in this thing. If you invested at 5 crore valuation and that
Hmm.
becomes 5,000 adjusted for all the dilution, then you have
Hmm.
made 1,000 times. Okay.
Yeah.
Instead, if you enter the same company at 50 crore valuation, you made only
Yeah.
100 times.
Yes.
Why this
Yes.
100 versus 1,000 is important is it gives you luxury of how many other wrong investments you can make, and yet make returns on your overall portfolio.
Right.
That is why entry valuation is very important. Although
Got
some
it.
investors may disagree, but
Hmm.
entry valuation discipline is very important,
Sure.
even on the
Sure.
listed side.
Got it. Got it. Yeah, sure. So all those who are keen on becoming angel, be cautious. What Samir is saying is, if you're investing 100 rupees in a startup as an angel, the chances of that 100 becoming zero is 90%. The chances of that 100 becoming 1,000 is very little. Therefore, it's a very high risk and extremely high rewarding thing. So if you're willing to lose that 100, which is more likelihood to happen, then become an angel investor. Even to reduce those risks, go with somebody who understands the domain, who understands the founder, who understands the space that particular business is operating in. Ask around and then do it. Just don't jump into it just because it's a fad thing to do.
Yeah,
Samir,
I think it's
moving
very
on.
important to analyze
Yeah,
in depth what the company is doing, what are the capabilities of the founder, etc. There will be a lot
right.
of blind spots. There will be no like clear answers to every question that you have.
Sure.
So you go in little blind, but still it has to be a calculated this thing.
Of
You
course.
can't go completely blind. You need to do some deeper analysis.
Sure. Samir, as an investment banker, you must have seen both at Vidura and even while you worked in other companies, other institutions as an investment banker. You've seen founders, you've seen investors on both the sides. You had a front row seat when all of this action is happening. Tell us something which, if I'm a founder and I'm trying to raise money, what is it that investor will immediately lose interest on? Right? The basic don'ts that a
Right,
founder
right.
should know about
Okay,
that
okay.
that one should avoid. Yeah.
Sure. So one of the frequent things which leads to rejection or loss of interest from investors is if one is trying to be a hard seller. Okay, he's very desperate and he's trying to hard sell the opportunity. Okay.
Sure.
This is one obvious no.
Hmm.
The people on the other side of the table are smart enough to appreciate the opportunity. So one, there is no real need to hard sell. Okay,
Sure.
that is one. Okay, and second another thing is, a founder typically delivers a pitch, what problem he's solving and why the team is very capable, what is
Hmm.
the traction they have had, how big is the market, all those things. Then the investors listen to all of this and then they go deeper to understand second level, third level
Hmm.
details.
Hmm. Hmm.
So during that discussion, if the founder is found wanting in terms of the depth, if they, assess that he doesn't have the requisite depth, he has not
Hmm.
thought through in as much depth as they would have liked to. Of course, no one is expected to have all the answers, but if by looking at all the second level, third level details, how he has handled, if they
Hmm.
feel that the
Hmm.
depth is lacking, then also
Yeah.
they say no. And then
Yeah.
there are
Yeah.
many other standard things which are, bit of a question mark, which raise
Hmm.
bit of red
Hmm.
flag even
Right.
before the
Right.
meeting, in which case they don't meet only. For
Okay.
example, people don't like say single founder companies, the
Right.
institutional investors, not to
Hmm.
say that single
Hmm.
founder companies cannot be successful. There are enough and more examples, huge
Right.
number of examples. Dhirubhai Ambani was a single founder. To the best of my knowledge, so many people in the Western successful tech startups, they are single founders.
Hmm. Hmm. Hmm.
But VCs, because they give capital and they expect to multiply it at a rapid rate in a certain timeline, they always believe that if there are multiple co-founders, it reduces the risk for company to kind of not do well or something. As in, the chances of it doing well get enhanced. Okay, so
Sure.
that is another thing.
Sure.
And what these founders have done in their previous roles, what kind of
Hmm.
impact they
Hmm.
have created.
Hmm.
So these are some
Hmm.
of the
Hmm.
things.
Sure. So the depth of what problem I'm solving, how big is the problem instead of total addressable market, what is my go-to-market strategy to capture whatever X% of that market, what is
Right.
capital required, how much time required. So I think we might, all of those answers need not be right answers, right? But
Yes, yes,
that conviction in those answers is more important because as we know, like quarter or quarter, these things will change, right?
yes, yes,
But
yes.
the depth of what I'm trying to know is what investors would look at, and then a passion with which the study that I've done with which how well do I know that piece,
Yes.
right?
And why are you uniquely positioned to make
Sure.
it
Yeah.
successful?
Yeah. I
Let's
mean, the
say
one of
from
the
your past experience or how deeply you have faced that problem and how unique is your solution in terms
right.
of, the competitive modes.
Got
Like I
it.
said, I will repeat it, that you
Huh.
are competing in the market. So why are
Yeah.
you positioned uniquely to succeed vis-a-vis other companies? So those ingredients they look for. Even, I mean, it can be a good thumb rule for angel investors also. Does things, I mean, the idea, the opportunity comes to you, is it making you feel like, wow, this is something,
Hmm.
exciting, and whatever they are saying looks realistic, and this is something that you want to be part of. Okay,
Sure.
so those are also, one need not be, out and out professional to appreciate some of the obvious things,
Of
right?
course.
Yeah,
Yeah.
yeah, yeah.
Sure. So I mean, I think in the interest of time, I think there are a couple of interesting things that I wanted to do, which is like put you in a spot a bit and then
Sure.
make you choose one or the other. I know life
Yeah.
definitely, business is never binary, right?
Yes. Yes.
Uh, but binary help us understand what lies in between, and we know that the reality is always between the two, right? So
Yes.
if we, so I won't hold you on to which side you choose. I know that okay, you are on that side of it, right? So it's not
Yes.
zero or one. It's not neither black or white.
Yeah.
It's somewhere in between. But I want you to make a hard choice here, right?
Sure.
So a little bit like so because I'm sure there are a lot of youngsters here who get offers from startups, and then you say, okay, this is the ESOP you get, and then this. Just to give you a context around this question, Samir, with your permission. So a lot of startups typically can't. They want great talent, but they can't afford the salary in the beginning. Therefore, they give what is called as an employee stock options. So they give
Yes.
you ESOPs instead of a salary. so that if when company does well, the employee makes really, really lots of money. Just to give you guys an example, when Freshdesk eventually went public on NASDAQ, right? 600 people in Chennai made $100 million. These were 600 early employees of Freshdesk, right? So that's the amount of money. And why? Because these early 600 employees got ESOPs from Freshworks, right?
Yes.
So, and we've heard these stories, right? The day Facebook went public in the US, I think there were some 200 millionaires in Silicon Valley alone on that one day. So it's a crazy thing. So it's very attractive for employees to join a startup for this. So now here is an option, right? If somebody gives you, imagine yourself to be just passing out of IIM Calcutta, you got an offer from a startup, and then obviously you got an offer from McKinsey, right? So the startup is telling you that I'll give you ESOPs worth 10 lakh, right? There's another thing saying that, okay, maybe, but there's somebody's offering you 5 lakhs more in CTC as a fixed component of your salary. What do you choose?
I will choose ESOPs. I mean,
Okay.
assuming the company is exciting, doing something, because by nature, it varies from person to person, right? So it's your individual risk appetite also. You know, joining a company which has good ESOP policies, it's like you are an angel investor, but you are closer, you are getting to know, you have a much closer seat to what
Okay.
action is happening in the company. Then you can even assess whether the company is going to be successful or not. You have a better, sight of that. Okay.
God.
So it's a very good thing because you are getting to enjoy the upside of equity without taking complete risk with your career, like trying to become a founder yourself. So it's a very good balancing act, I would say. So it's always good to join a company which and it need not be startup alone, right? There are matured companies also which give ESOPs. We all
I know.
know of Nvidia, Broadcom, and many other companies which were already big, and from there they became another 50 times, 100 times, whatever. So ESOP is a very good way to play that game of generating equity returns.
Got it. So you will choose an ESOP of 10 lakhs and give up on a 5 lakh fixed salary, right?
Yeah, definitely.
Okay, cool. Sure. The other this or that, Samir, I think some people in the audience are asking you to speak up a bit. I don't know, just see if you can increase your volume or come near to your laptop.
Is it better now? Is it better?
For me, it was always better. We'll have to see if it's getting better to an audience. Right?
Okay, sure.
So the dilemma for most of the founders is like, okay, they get to a stage where they've just about started making profits. They had a good run for last 5-7 years. They're at a stage where somebody makes an offer of 100 crore acquisition. You take 100 crore today, sell your company to me. Right?
Yeah.
Or the other option that I have is, no, I still have that in me. I will work for another 3-4 years and take the risk and get to 1,000 crore IPO. So 100 crore now and you sell your company, or 1,000 crore after 4 years of more struggle because you already struggled for 7 years, right? And you leave 100 crore on the table, then go for 1,000 crore IPO.
No, absolutely. It's a very good question. And again, no easy answer to it because 100 can become 1,000 also, 100 can become 0 also.
Yeah.
Okay. So what is the founder's inner voice saying? Okay.
Yeah.
Many times what happens also is founder knows it can become 500,000, but he just doesn't have energy to pull along. Just day before yesterday, I think I met a owner of a company. He has been running the company for now 31 years. Okay. 31 years. He's the number 3 player, quite substantial in size.
Yeah.
So he is now saying, I know if I stay put for another, 4-5 years, I can even make the value 5 times, 10 times. But I am just not enjoying it anymore because I want to spend more time with my grandchildren, etc. So the personal angle also comes into play.
A lot, yeah.
Okay.
I agree.
So to each his own. Sure. It's like asking a cricketer what is the right time to retire, right? So he knows there may be more, energy left to play for a couple of more years, but he thinks he has had enough,
Yeah.
So it's all an individual call beyond a point.
Sure. Sure. Got it. No, yeah, it's true. I mean, for me, I had to make that choice in 2018.
Right.
Will I sell the company? It was 100% acquisition, or would I
Okay.
continue to build? As you said, it's a very personal choice.
Yeah. I think you sold, right, in 2008.
I did. Yeah,
Yeah.
yeah,
Yeah.
yeah.
Yeah. So to each his own. There is no right or wrong. So beyond a point, it's not just money, right? There are many other
Yeah,
things at play.
of course, of course.
Yeah. And then there is no guarantee. There is no guarantee that 100 can
Yeah,
become 1,000. There are absolutely no
of
guarantees.
course, there are no guarantees. Yeah. So Samir, I think let's take a break from heavy investing. And since I know that you are a cricket Sachin or Kohli,
Sachin.
I would say Kohli though. I mean, Sachin is a good large cap and Kohli is a startup, isn't it?
I mean, each have both of them have made like great contributions, played in
Huh,
different era. But I
huh.
think when Sachin played, the challenges were far more.
Yeah,
I thought.
I agree.
So in terms of even the quality of the infrastructure and many other things, and the
Right,
quality of ballers
right.
that we face, it's actually unfair beyond a point to
Yeah,
compare.
I agree. I completely agree. I fully agree. Yeah,
Yeah,
let's get
yeah,
back.
yeah.
Okay, let's get back to investing. Right. The last one, perhaps, Samir, before we try and close. If I am an investor, I have two choices. Again, the extreme examples I'm giving. Great team, but not such a great idea. Right.
Okay.
An ordinary team. When I mean ordinary, like not great pedigree, etc. Ordinary team, but a great idea.
Right, right.
Which one
So,
would you
so
bet on?
yeah. So I think beyond a point, pedigree is not an indicator of quality. Okay.
Hmm.
So when you say great team, for me it's a great team. Okay.
Okay.
So every
Okay.
investor wants to bet on a great team. So
Hmm. Hmm.
if they believe that the team is not so good, it's very ordinary, then they will not put money. Okay. So many investors, they the highest weightage they assign is to the quality of the founders. Okay.
Hmm.
Then
Hmm.
comes the market traction, etc. If they are investing very early, then yes, there is not much traction. There is no
Yeah.
option. There is nothing much you
Hmm.
can analyze about the traction. It's just the team and the problem they are solving. So
Right.
I believe team always takes precedence.
Got it. Yeah.
Yeah,
Yeah.
yeah, yeah.
Because what I hear you say, Samir, is ideas are fine, but it's executing it that
Yes,
matters,
yes.
and that requires a team who can really
Yeah,
execute it, right?
yes.
More often than not, whatever that idea you had will change 2 years, 3 years, 4 years. And there's really a nice term for it called pivot. Almost every startup from Airbnb to Zomato are not doing what they're doing today. That's
Yes,
not what they
yes.
started off with, right? They
Absolutely,
all
absolutely.
have pivoted.
Yes.
And they were able to pivot, execute, continue, and even though the idea changed or some of the concept changes because of the team that matters, right? So
Yeah. So actually, being flexible
hmm,
keeps
hmm,
you alive to opportunities. So if somebody is very rigid, it's
yeah,
not necessarily, a good thing from an investor perspective. So they assess
sure,
that as well to answer your question, what all they look just
yeah,
beyond the numbers and the pitch, etc.
sure. I know again a tough question. I know you will say like, but I want you to. I want to know what you think, right? Would you focus on profit? Would you focus on growth? If you were to focus only on one of the two,
Right, right. So if I'm investing early in a company, it's understood that it is already loss making. Okay.
hmm,
So I mean, those who invest very early
hmm,
stage, they invest for
hmm,
growth. So
yeah,
growth is a absolute non-negotiable. So if I have to pick between growth and profit, I'll pick growth. But
okay,
if
okay,
you ask me about the ecosystem, right?
hmm,
There was a
hmm,
time when people just did not bother about profits because they thought if you grow well enough, profits will come. Will come.
yeah,
But now the whole ecosystem has become very, very disciplined about path to profitability. Not exactly
hmm,
profitability
hmm,
as on date, but path to profitability. Are we just growing by recklessly throwing money at customers? So it's not a profitable growth, right? The minute you stop, giving those incentives to customers, then the growth will
hmm,
stop. So there is
hmm,
also quality of growth. Quality of
sure,
growth. So I would
Sure.
look at growth for sure, but I will look at it through the lens of quality. So if
Got
it is
it.
passing the quality test,
Yeah.
then that growth is a valid growth. Okay.
Sure.
And likewise, the path to profitability. As on date, there may not be, it may not be profitable, but is the cost structure correct? Is there a discipline on the cost? Are they, maximizing the revenue enough? Okay. Are they pricing their things right? So these are the things which will make the company eventually profitable if it is not already profitable.
Got it.
Yeah.
Sure.
Yeah.
Sure.
Yeah.
Brilliant.
Yeah.
I think I love that answer, Samir. I think path to profitability, a clear path to profitability is what I hear. You
Yes.
need not be one now, but you're growing and you're focusing on growth, but there's a path at some point of time. And
The quality of growth.
quality of growth, it's so important, right?
Yeah.
I mean, so if you're throwing money to just acquire customers,
Yes. Yes. It's not a good quality growth.
it's not a good quality. Like, so CAC is one of the numbers that we look at, cost of acquiring a customer.
Yes. Yes.
How much are you spending to acquire a customer, and what is the customer lifetime value, right? I mean,
Yes.
so
Yes.
CTV to a CAC is a ratio that we track. For
LTV.
some of
Yeah.
you,
Yeah. Lifetime
getting
value.
little technical here, right?
Yes.
So, what is the lifetime value of a customer divided by what does it cost to acquire that customer? So, typically called as LTV divided by CAC ratio. So, in good investors have that in mind. They look at that number very carefully and then say that, okay, that determines what Samir is saying as good quality growth versus bad quality growth, right? So, and there are a couple of other things. There's a rule of 40 that I've become personally a very big fan of, right?
Right.
Wherein the sum of your growth percentage and then sum of your EBITDA margin, right, should be 40, right? So, for example, if you're growing at 200%, which means you're doubling your business year over year, it's okay to make a loss of 160% because the sum is still 40, right?
Yeah. I mean,
But
yeah, this is the thumb rule for certain type of companies like SaaS.
yeah, for
Ultimately,
SaaS.
these are all derived things, right?
True.
Derived things. Ultimately, if you go by first principle, it boils down to growth and what profits will this company make on a steady state basis when the investor wants to exit. Will it become worthy for listing, right? So
Yeah.
these are the things
Sure.
and people know that there are so many uncertainties. No matter
Yeah.
how many good investments any investor has made, he's still learning, right? Even the seasoned investors keep telling that they are learning,
Sure.
so still getting started, if that's the benchmark. So what I mean to say is, ultimately there are so many unknowns. That's why people take a bet on founders. If they assess that founders are, very sharp, very good, etc., they will figure their way out to profits. They will figure their way out to, adjoining products, adjoining
Sure.
revenue streams, and
Sure.
then they will get to, stage where they will give them a good exit. So there are many unknowns when it comes to, investing in
Sure.
earlier stage companies.
True. But just as a thumb rule, like I kind of liked it.
Yes.
You're making 20% profit and you're growing at 20% is fine. You're making
Right.
30% profit or you're growing at 10% is also fine. You're growing at 200% and making loss of 160% and that loss is funded by an investor is fine, right? So that gives me a flexibility to look at it. And then, but quality of growth, wow. I mean, that's an insight for me, Samir. One last one before we find out. I really wanted to close this in an hour. I know there are a lot of questions from the audience. Somebody asked me, okay, did I regret selling my company to her? No, I don't. It was a great deal. The time was right, both for the business as well as for me to sell at that. Very grateful for that event to happen. Gave me a lot of options in last 6 years to spend my time on things that I really love doing. So it gave me a lot of flexibility. No, I don't regret the exit of 2018 for sure. So Samir, one last thing before we close. Like one or two or three top. I know you covered this in your question, but typically just top two advice for a founder when they're raising capital.
Okay. Top two. Okay.
Yeah.
So First, I would say the team, right? Does the founding team have the right complementary capabilities? Okay. That is the first. And second, they should be able to inspire confidence to, if I mean, I'm assuming you are asking this question from the perspective of raising venture capital, right?
Yes, raising venture capital if I'm a founder. Yeah.
Yes, yes. So one is the team in place. Second, the second important aspect is why are they positioned uniquely to grab this opportunity, and their ability to scale. If you are good at a certain scale of business, there are no guarantees that at 10x that scale you will be equally successful. So people really try to look into the future. As far as the founder capabilities are concerned, can he handle 10x 50x the scale of what the business may be today? So their ability to inspire that confidence is can take them a long way, because I believe the outlook for capital raising, outlook for building companies successfully, etc., is very very good. When we look into the future, but not every company will have that privilege of raising capital successfully and growing, etc., right? I'm talking purely through the lens of raising institutional capital. One can still build businesses without raising any external capital. That's a different topic by itself, not to undermine that path to growth. In fact, that's a very beautiful path. You are in complete control, you are not under pressure. So there are many good things about that approach. When it comes to this approach, the outlook is very bright because there is huge supply of capital, but not every company which goes and tries to raise capital will be successful. So we have to be realistic. So for them to be successful, these are, I think, 2 or 3 very key ingredients.
Got it. Yeah. Thank you. Thank you so much, Samir. I think
My pleasure.
I wish when I had started my company, I had listened to this podcast. I would have made lesser number of mistakes. So therefore, from that angle, I think for a lot of youngsters who want to start or are in the beginning in their business, I think this was very useful. We covered, just to summarize our conversations before I close, we talked about why does a business require capital, and especially a equity capital. What are the ways, what are the stages at which we raise capital? What does it take to raise an equity capital? What are some of the good things and bad things about raising equity capital? A whole lot of stuff that we've covered. I hope we were able to keep it as simple as possible so that we get the fundamentals. This is a whole study in itself, guys. So Samir, being an investment banker who helps companies raise money, as he said, it's a huge science and an art. But I hope we were able to do justice to those who wanted to generally understand. Now, when you read in Economic Times or somewhere that this company raised 5 million in Series A, hopefully you know what it means, right? Or when you get to know that, okay, this particular early stage investor exited at 100x, I hope you know what that really means. Thank you so much, Ajit Alumni Association, AAA, the Office Bearers, for giving us an opportunity to do this. We have stalwarts in the audience, guys, by the way. Of course, a lot of youngsters. So this is first of the series where we thought that we will pick up slightly difficult topics, do this in a conversation way instead of a monologue, because it's hard to keep people's attention nowadays. Get the audience participation, ask them some of the questions that they have, but also go really deep into some of these subjects that we have. We would like to continue with this month over month, hoping to build a great Ajit community to begin with, and then perhaps the larger Saidi School alumni community, and then maybe even bigger than that, right? We never know where the world takes us. Thank you, Samir. Thank you, audience. It's been great.
Thank you for having me.
Right. Do reach out to us if you have anything, follow up. Bouquets and brickbats, all the more welcome. Brickbats, more importantly, how can we improve? What can we do better? Please write to us on the YouTube channels and Spotify channels when we release them. Thank you again. Have a great day. Jai Hind. Namaste.